The game of trading is price related, not green candle, red candle related. For my trades to work well, I need movement because movement is what creates fair value gaps. This is the phase that actually SMC traders will do better in, not in this phase. As a trader, you need to figure out, when I operate, am I in this market? Am I in this market? They think the broker is God, while the big boy treats the broker like shit because he knows the broker works for him. So in this video, what I want to talk about is what are some of the things that the SMC does really, really well, and how are some of the things that can help you? What are some of the things I've shown some of my students who came from SMC, and then what are some of the things that once they tweaked a few things, then suddenly they had a little bit easier time passing with their prop firm challenges that they've been failing for quite regularly. So let's talk about some of these things. So let's talk about fair value gaps first. Now, everyone in here who's done a little bit of SMC before will say fair value gap there, fair value gap there, right? It's the stuff that you see this little tail that comes up, you see this little tail that comes down. There's a empty area on this candle in the middle that is untouched. Same thing here. There's a wick on top here. This full candle is empty, empty, empty. Next candle opens, the tail comes this far low. In between these two red lines is considered the fair value gap. So the concept then becomes is fair value gap plus a percentage of pullback. So I had the student, very, very skillfully explaining the rules to me like a diligent student would. And I would ask one question. What if X happens? What happens if I take you to a different market? Suddenly, there's so many confusions that come at you because it's like everyone must have a driver's license. To get the driver's license, you have to prove you know how to drive, right? If you prove you know how to drive, in that process, did they ever teach you how not to get an accident? No, it's something you learn on the job. So this is very similar to that. Trading is like that. You can get your license by learning a few things here and there, but you gotta be open to the exploration of trading. You can't just be stuck there and saying, I got my license, I'm a trader. Okay, stop. We're labeling everything. Now begin the trading journey. Take your labels and begin. So that's where I see that little gap there because that experience hasn't built on those labels. Okay, so how do we demechanicalize this thing? So fair value gaps is one simple concept is the goal of trading is exchanging of products. Okay, I have this, I give you this, and we exchange. That's the game. So in this process, if someone is selling something to you very expensive, are you going to buy it? No, you're not going to buy it. So this part doesn't exist. It's not trading. The trade did not happen. Now you must be thinking, like, I know that stuff, Navin. I'm going to test it a little bit. Okay, everybody knows this stuff, but we don't use it in the markets. When we come to the markets and we look at this chart here, we see, okay, I see a fair value gap there. I see a fair value gap there. I see this is a 70 something percent retracement here. So this fair value gap is better than that one. Okay. And then price comes here and then it takes off there. All this stuff, the focus is here. Very narrow focused. Not one is looking here and saying, and what happened to the price now? Because the game of trading is price related, not green candle, red candle related. It's price related. I pay you this much or I'm not going to buy it. Oh, what if I pay you this much? Oh, I'm not going to buy it. What if I pay you this much? I'm not going to buy it. What if I pay you this much? I'm not going to buy it. What if I pay you this much? Okay, this movement that goes from here to here super fast, that creates fair value gaps or unfulfilled orders. Okay, which means I want to buy, but I don't get. Therefore, I have no choice but to offer a higher price. You still don't want to give it to me? A higher price. You still don't want to give it to me? A higher price. Two things are happening when this fair value gap is created. One is someone wants to fill. They want to fill, right? But two, it's giving me a clue about the demand. Someone is cuckoo about this thing. They want this. Now, if someone is that crazy for that product, what makes that price of that product come down 70% discount? Have you ever thought about that? No, but 70% is good. Anything more than 50% is considered premium price, and premium is good. Yes. Everybody's read the same Bible. Take a moment and you gotta think. What makes the price come down 70%? Is there something wrong with that demand? What happened to the guy who really wants this product? You see, these questions cannot be answered accurately, there's a gap in the education because it's price that's moving up. It's price that's moving down. And if price is not sustaining, then price doesn't move. Okay, so let me do this. If I draw something like this, it goes up, it pulls back, and then it goes up, and then it pulls back, it goes up, it pulls back, it goes up, it pulls back, it goes up, it pulls. Okay, what did I just draw? Oh, this is a high tide flag. Now, great. Many people know this word. They've studied it somewhere. But what is this? It is super high demand, which means people are not getting filled. No one is selling that product, which means price is not coming this way. It's going that way. The speed it's going that way is telling you, oh my goodness, someone really wants this and no one is selling it to him. Of course, you're going to get a fair value gap. Do you think you're going to get filled in this? A person from a different technical analysis background that says this is a sign of a breakout that can pop and fly upwards. Okay, stock traders, they do this all the time. Now that logic is kicking in of, I know why this looks like that, because whoever was selling is selling less and less and less. Why is it less and less? Because it's being absorbed. Do you know in this sequence, your volume also generally tends to decrease? All of these signs are telling you it's for a buy. Now, you see how I'm connecting multiple elements? I'm trying to make you think of why draw the design that way. Look at the volume to understand the behavior as cells are trying whatever supply that there is, it's being consumed by the buyer. Of course, there's going to be fair value gaps in this part of the flag, in the pole. Fair value gaps there. Price is not going to come there. You're not going to get a 70% retracement on this thing. Then the question is, well, then if I don't get a 70% retracement, then I shouldn't buy it. It's okay. That's not a trade for me. Great. You need to understand why it doesn't come down. Now, the opposite thing I want you to think about is, what if it does come down? You're like, ooh, he's at my area that I'm supposed to buy. Isn't there a single thought that goes into, my friend, the price demand went from here to here. They went absolutely berserk crazy to buy this thing, and then now they're pulling back down. Why did it come down 70%? And if it comes down, will it buy again? How do I know it's gonna buy again? Apart from there's unfulfilled orders. So you gotta close that gap to find out, I do know someone is there to buy that thing. Now, stay with me. I say on a lower time frame, inside this, you are here and you create a fair value gap there on a lower time frame and it comes down 70%. Do you know if they're gonna buy it? Oh, that changes everything. Yes, they're gonna buy it because they're in a mode of buying these things at higher low prices. That 70% is fantastic. Bloody buy it. It's a very different thing. So to understand the flow of the market is the absolute universal basic. For my trades to work well, I need movement, because movement is what creates fair value gaps or unfulfilled orders. Does everyone understand? Now, one key part to really hone in on and understand, as traders, market moves in a particular fashion. It moves, it goes, pause. It moves, pause. It moves, pause. I want you to think of it this way. The market in the professional language is called price discovery. But what it basically is price is looking for a home. Just think of it, it's hanging out here for the longest time. It's doing all kinds of stuff. It's moving up, it's moving down, higher lows, lower highs, up and down, fair value gaps, change of characters, ups and down characters. Everything is doing that. And then unacceptable price moves to the next, looking for the next home. It moves. This is the only two-way the market behaves, in this or in this. As a trader, you need to figure out, when I operate, am I in this market? Am I in this market? If I'm in number one, I'm going to get a ton of 70% pullbacks, no problem. If I'm in this market, forget about it. Let's go deeper. If price is being discovered, it's looking for a home. Think of it like that. Two things can happen when it's looking for a house. You can be the trader that does the buying, or you can be the trader that does the mean reverting, because it's gone too far. But for whichever way you are doing this, as a trader, you can belong to either of these camps in the price discovery. You make the discovery or you reverse the discovery, okay? Reverting of the discovery is something like this. I'm gonna show you guys. Now, ready? Take a look at this. Let me move you to here. Okay, on this chart, this thing is moving up from here all the way to here. 665% move in a matter of days. Okay, a million fair value gaps inside. 70%, 80%, 100%. Everybody steamrolled. Why? This thing requires a little bit more understanding. This is a car rental company. This company is called Avis. You guys heard of Avis car renting companies? Suddenly, out of nowhere, this car renting company is making 500-600% moves in the stock market. People really want to buy this thing. Oh my God, they want to buy this thing. It's grabbing my attention too, because I'm a guy who likes to deal in things that are hot. So I need to find out, why is this hot? And I find out it's going crazy because the airline industry in the US, the government had a shutdown, and that made the TSA not working, and there was delays and everything. People like, screw flying. We're gonna rent a car, we're gonna take a car. So everybody's driving a car now. That increases demand. Now you tell me, in the world of stock market, this is a company. Things go up because a company performs well. Do you think this company is making more money and it's gonna continue to make that amount of money into the future? Like suddenly, if he's making 500%, can he do that again next month, 500%? And the next month after that, 500%? No, why not? Because that means you are saying that TSA or the airport security is never gonna come back to work. That's a little silly, isn't it? So now they come back to work, the airline industry is back in business, and the whole thing collapses. What happened to my moving average trading? Wait a minute, what happened to my higher low sequence trading? What happened to my kangaroo pattern? You can label anything. You need to understand what you're dealing with in the market. You can't blindly come in and saying, you see this? You see that? This is called a higher low. You see this? Look how perfectly it connects. That means we have a trend line. Trend line equals orgasmic, therefore money. No, like, okay, it's easy to learn these things, but you gotta be a little bit smarter than that to say, that's a little silly, don't you think? So if a move creates fair value gaps, the very first thing I would like to do is, what caused the move? I need to figure it out. And then I will say, ooh, that's good. Then I say fair value gap is gonna be fantastic. So first I need this check mark to clear. Okay, next thing, why should it come down 70% to come pick you up if they're literally screaming, this is hot? Who's gonna give you a 70% discount if they're going bananas for this product? I didn't think of that. I mean, the rule says pick it up at 70%, but because I shouldn't chase. That's the answer. Okay, that's a good answer. You shouldn't chase. But why should it come down 70%? Actually, more than 50% is considered premium. Okay, great. More than 50%, fine. Why should it come down 50%? You see, you gotta probe yourself with these questions and saying, do you really know? Do you really know? Or is this a labeling mechanism? Because you can't label your way into money. I so wish, man, we can label our way into profits. So the very first thing is identify what caused the movement. Yeah. Once that's clear, then go do your fair value gap stuff. That's fine. Identify those levels or areas and let it be in the premium spots, right? And then answer the next question. Why should the price get there? If it does get there, how should it behave on its way there? Should it come slowly? Should it come fast? So here's a thing that we talk about. SMC refers to as liquidity grab. We refer to it as the vendor game. Does everyone understand vendors? Vendors are the sell side of the game. Okay, sell side of the game. Now, normally when I use this word to new students, when I say sell side, their mind goes, oh, you mean not buy, the sell. No, that's not what I mean. The sell side of the game is, if you want to buy a stock of Apple, you need to get someone to sell you that stock of Apple, right? So you're not going to knock on someone's door and say, hey bro, you got a stock of Apple? No, you got to talk to your broker who's going to sell you this. You're going to talk to an agent who's going to sell you this. Wall Street is considered sell side of the business. Now, when it's the sell side of the business, the focus is you make money or you lose money. I don't care. I want my commission. The sell side of the business is cutthroat. You made $1 million today. Good for you. You lost $1 million today. Good for you. Where's my commission? Sell side of the business is just that. They don't care what you do. So far, so good. You guys understand it, right? Everybody here who's traded even one trade understands this. That you're trading from a platform that someone needs to sell to you whatever it is that you're trying to buy. Yes, let's go into the dark side of the business a little bit. Now, liquidity grab, as the word is thrown around. How do you do a liquidity grab? Have you, together with your friends, tried to put together some lot size and saying, hey man, you, me, my friends are gonna buy so much that we're gonna move the price from here to here, and then we're gonna sell the crap out of this thing. How many people do you know do that? Zero. You know why? Cost money. If you're in Forex, you better have serious cash. If you're in stocks, you just need to have more than whatever the trading volume is. Simple. If the trading volume average that they trade is approximately $1 million per day, $1 million per day is their average trading volume. You got $100,000, $300,000. You can be part of that market. In Forex, forget about it. You need billions. Now, so the idea of liquidity grab, it's not for the Joe Schmo, it's for the big boys. How the big boys operate is, let's say, prices are moving here and they're doing this. They're doing this. There's a clue that you have and I have. Big boys want this thing. Pattern traders look at that thing, says, I want that thing so badly. I know it's going to be a buy. And when it's a buy, we're going to buy this. We're going to go to Maldives. That's what the guy on YouTube said. That's the idea, right? Everyone is gearing up. So the big boy says, I want $50 million worth of shares on this thing. 50 million. But the people selling is only 5 million. People selling is only 5 million. You know what the big boy does? He picks up the phone and he calls all the vendors, big ones, and he says, listen, MF, I need a price to get filled around here. I've been doing business for you for so many years. If you mess this order up for me, go find another job. Now, Joe Schmo down the street, on the other hand, Mr. Broker, can you please approve my application? Please, please, please. They think the broker is God. Well, the big boy treats the broker like shit because he knows the broker works for him. The average person treats a bank and their broker as if that's God. It's not. You forget they work for you. When that distinction gets lost, it's a problem. So he makes that phone call. He says, I need these prices. What they say is, yes, sir, we'll find a way to do this thing. As prices move in a particular way, brokers can manipulate the spreads a little bit, causing prices to fluctuate and waterfall. That's what causes people to jump into the buy, place their stop losses, and then prices come down. And once they come to an area where a stop loss might be, we're watching for how quickly does that price recover. If it recovers like this, it's a big order, baby. So the concept of liquidity grab is a big boy's game. We call this a vendor game. This happens at very strategic locations. You need to figure that out and then understand where the dash of evil. So it's how you read. It's do you understand the demand? It's how you understand the vendor. It's do you understand the different players in the market? How does the big boy operate? What is his headaches? How does the little guy operate? The little guy has no headaches. If he wants to buy and he says $50,000, you'll get filled. If he says 50 million, phone calls will go around because no one can find orders to fill him. He has a different problem. You need to understand what this problem is. Because if you understand how he feels, you can perform 50 times better than you're doing right now by saying, if I just draw a line, that line better be good. No, man. Yeah, but that line, maybe if I use a scientific ruler. So we can all label things. So we're good at labeling things as humans. We love patterns. It's good. But what I'm trying to tell you guys is when I have SMC traders coming to me, we've got a lot of good knowledge. You just need to fill in the holes of, wait, do you know why this happens? Do you know when you should not do this thing? And as we start closing that gap, suddenly these guys become very profitable because there's so many big gaps in between where the labeling is good, the knowledge is okay. I wouldn't say it's bad strategy. I'd say it's a pretty decent strategy. It's just we got to fill in those gaps. You've got a driver license, you've been handed a manual to a Ferrari, and you're like, all right, where's my Ferrari? Like, what do I do now with this manual, right? And you're like, I know a Ferrari has 4 tires. Yes, my friend, everybody knows a Ferrari has 4 tires. Why does it have 4 tires? Like, let's start there before you're like, let me show you on the manual where the steering wheel is. Like, let's stop labeling stuff and let's get into the meat of trading. Is this making sense? Do you see where the gap in the knowledge needs to be filled? Okay, that gap needs to be filled in properly, and then it will become a lot easier. Okay, so one of the things that we like to do is make sure that you have something that tells you to distinguish what kind of market you're in. Are you in the market where price is chilling in a house? Or are you in the market where the price is looking for a house, right? prices move in that fashion. House, next. And then you ask the question, am I the guy who brings the price down? Or am I the guy who likes to trade with the price? Are you trend trader or are you counter trend trader? Are you trader in this phase? This is the phase that actually SMC traders will do better in, not in this phase. They will do better in this phase. Now, if you do better in this phase, it's different in Forex and it's very different in stocks. So once you start to identify these things, the knowledge will get better. And that's when you'll be like, there's more to drawing. I need to get to grade 2, grade 3. I gotta level up because I'm telling you, SMC is popular. Doesn't mean it's bad, just means it needs a little bit more work. So I hope you guys had a good time. You understand what I'm getting at, and you don't have to just follow things A plus B plus C only to make losses, but still believe A plus B plus C is the way to go. Wake up, right? Out of the matrix. I hope you guys like this. Don't forget to like and subscribe. Again, if you want to pick up the Mastering Price Action 2.0, this is the entry-level course that is available on www.urbanforex.com/webinar. Thank you for spending the time with me. Take care. Bye for now.